Meet Kevin is someone that I follow a lot for real estate, stock market investing, overall news about the economy. And he just made a video about his concerns for the market. He talked about the slow bleeding out maybe that we might see, or how the market just might be flat for all of 2022. We've seen such a big run up that it's not uncommon that after such a run up, we might see a correction or just a slow deterioration. Now, in his video, he talked about maybe some of the important upcoming catalysts. We have the second quarter results that are coming out that are definitely going to move the markets. For me specifically, I'm looking at Tesla's Q2 earnings. And the thing that is more important when you look at things that can drive the market, it's not just what happened, but what's going to happen, right? The market is forward facing. It looks into the future and it decides what the price should be based on the potential for it to hit a future result. So Q2 is one thing, but guidance on the future is another. Tesla on July 26th on market close on Monday is going to be releasing the Q2 earnings. And as companies come out with guidance for the future, we're going to probably see them talk about things that we might be in for some unexpected flattening or maybe even a decrease, because we've seen a boom. We've seen a boom from maybe stimulus checks. We've seen some crazy inflation numbers. We've seen just prices of things going crazy. And as we start comparing things, you have to realize that humans compare things based on other things, right? That's how we decide if something is big, if something's low, if something's good, if something's bad. And we might have a relative decline coming up as things start changing. Like, for example, everything's based on year over year, or Q2 year over year compared to last year. And if this Q2 is really great, but next year is only good, we might see a big difference there. And inflation is one thing that we have a lot of inflation. It looks like if it doesn't last and next year we don't have those same crazy numbers, it might look like deflation. Everything is relative. Now, I believe overall that the market might be in for some crazy stuff. Now, I don't know when, I don't know how, and the most important thing is I'm not betting on it. So even though we got a pretty good amount in the market, it doesn't. These things like a day change of $26,000 down today doesn't affect me, and that's because of my time horizon. Everything is relative. So as you're looking to decide if we are in for the next bubble, that's my last video. Go check that out on Michael Burry's bubble prediction. Leave a card up here for it. The big thing that is important for you is understanding your time horizon. So time horizon is the most important thing. And if you have a long time horizon, like some of you guys are going to be chilling for 10, 20, 30 years, then none of this really matters, to be honest, right? The news doesn't really matter. Whatever happens, just keep dollar cost averaging in. That's what I'm going to be doing. However, if we do see a pretty good pullback in some of my higher conviction companies, I might be buying in. I'd like to have more QQQ, the NASDAQ and technology sector, but it's like so crazy priced right now. So if things pull back significantly, I will be buying more and faster, but my strategy overall is to just keep buying. And it's not something that matters to me because of my long time horizon. So when I say, maybe I'll put 100K into this more speculative stock, remember that everything's based on scale. So for 100K for me, it's like 3% of my portfolio. So realize that also when we look at numbers like this, which might seem so scary, you got to look at the percentages. Everything is relative. Now, before I kind of talk about the next potential big bubble that I'm looking at, make sure to subscribe if you're interested in building your wealth. What we're going to do is the first 1,000 subscribers who subscribe to this channel are going to be locked in for extra perks for the lifetime of this channel. So make sure to subscribe. Let's try to hit that 1,000 mark. And thanks so much for doing that. I just saw you did it. I saw you did it. You just did it. Anyway, the next bubble that I'm kind of looking at, I'm a little bit concerned with, is this idea of the index fund bubble. Now, again, we got Michael Burry here with the glass eye that is saying, maybe passive investing has this extra risk level to it. And the reason is because, yes, what I'm going to be doing because of this crazy market is I'm still just going to be dollar cost averaging in to passive investing. Passive investing is my biggest holding. So yes, I might have some good amounts of Tesla and Apple and Amazon, yada, yada, but my biggest holdings right here are my passive investing of my index funds. Now, these funds with, I guess, 2 million in them, are the majority of my investing strategy, and I just keep buying. Now, there is a potential for a bubble, and the reason is because passive investing, for the first time a couple of years ago, passed non-passive investing. And passive investing is where there's just so much money that people aren't even really aware of what they own. Like, if you ask me the companies that I own, I can't name 99% of them. Like, literally, I can't name 99% of them. And that's because this ETF, this exchange traded fund, VTI, captures the US stock market. So we got 3,000 companies. And yeah, maybe I've only heard of like 300 of them. So I don't know a lot of the companies that are being held in here. And what these funds do, like VOO here, which holds the S&P 500, is that these funds are buying the 507 or something biggest companies in the US. And every time you buy into this fund, that fund essentially has to buy a little percent of each of the other companies to basically hold that as the percentage of what's in there. So what that does is I start holding companies that I don't even know, and companies, honestly, that I don't believe in, right? I don't believe in some of the companies that are inside the S&P 500. But overall, I know that I have a very high chance of being wrong, right? The 4% of active managers who beat the market aren't the same 4% of active managers who beat the market the next year. And that's because no one can successfully do it consistently. So I don't consistently try. And what this does, though, is that now there are companies that are inflated because these funds have to buy them, right? They have to buy them because they're part of these indexes. And so these funds buy them, they inflate the price. There's this external force pushing the price up. And whenever that happens, that's like, that's maybe bubble territory, right? When prices aren't relative to the performance of the business, when there's some weird external factor that's propping it up. Here's the thing though, is this sustainable? Maybe, right? Maybe. More and more people are going to these index funds, and as people are becoming more and more educated with the statistics of how active managing, buying and selling, picking stocks is really freaking hard to do, and then more and more people might continue doing it. So here's the thing. Even if there is a bubble, it doesn't matter. It just doesn't matter for me. Now, you might be different. You might not be a 25 to 35-year-old like 90% of my viewers. Click like if you are on this video. But if you are retiring in the next 5 to 10 years, yeah, this stuff matters. We don't know when it's going to pop. We don't know if it will, but there can definitely be some serious corrections. And so you want to make sure that you keep your scale and relative time frame in mind. That's the most important thing as you're watching the news, as you're looking at other information, as people are saying, buy, sell, bubble, crash, yada, yada. If you bought at the very worst time in 2007, when we had the crash, so like, let's go right here. So we bought at the very tippity top. Guess what? Well, it takes not super long to get to zero. So here we are. We are positive around 5 years later. And guess what? If you just held on to that, well, you'd be up quite a bit. We'd be up from the very top worst time till now, we'd be up 193%. Okay? 193% if you bought at the very worst time, right before the bubble burst in 2007 from the Great Recession. So I want to make sure that you keep in mind time frame, and I challenge you to think long term. And I also want to challenge you to think, if you're getting out of the market, you have a problem, because your problem is now, what's a better investment for you to make? And that's really the only reason to sell anything, in my opinion, is if you believe there's a better investment that could be made. If not, being in the market has beat timing the market and waiting for a drop. So data has shown that keeping emotions out of it and realizing your time frame is the most important aspect when you look at any of this from any of the YouTubers, any of the experts. And just remember, people are only right 4% of the time, and those people aren't the same 4% that beat the market the next year. So that's it for watching. Check out Kevin's channel if you haven't. Pretty amazing content and how he's able to come up with so much material. and absorb it and analyze it. So big props to Kevin, and I'll talk to you guys soon. Thanks.